Hello, everyone, and thank you all for joining us during the Lytham Partners 2024 Investor Select Conference. My name is Adam Lowensteiner, Vice President of Lytham Partners. Before we begin, for those not familiar, Lytham Partners is one of the country's leading investor relations firms with more than 2 decades of corporate access experience. We have built one of the industry's most diverse and effective platforms for connecting small-cap companies with high-quality and focused institutional investors while creating a framework of best practices in all aspects of investor relations. Today's discussion is hopefully yet another example where we can bring value to multiple constituents. To learn more about Lytham Partners and the investor relation programs we can provide, please access our website at www.lythampartners.com. Today, we welcome Mitch Pinheiro of Sturdivant Co. Mitch is a Senior Vice President, Director of Research at Sturdivant. He is a chartered financial analyst and has over 35 years of investment experience with a particular emphasis on consumer sector equity research. Mitch has been ranked on the Wall Street Journal's Best of the Street list in 12 out of the 17 years and was inducted into the Wall Street Journal's Analyst Hall of Fame in 2006. For additional information about Sturdivant Company and to see a full list of disclosures, please visit Sturdivant's website at sturdivant-co.com. Hi, Mitch, and welcome to the discussion.
Hi, Adam. Thanks for the time.
Sure, we appreciate your time as well. Maybe to kick things off, can you tell us a little bit about yourself, your background, and what got you interested in covering publicly traded companies and particularly the consumer sector?
Sure. So I've been doing this for over 35 years, as you can see by my gray hair. But my interest began back like in college, with what little savings I had, I'd invest. But really what my interest was really in problem solving. And, part of equity analysis is, being able to figure out the puzzle with the fewest tiles, overturned. So the fewer tiles you need, the better your investment return. So it's always been a great game, and I love trying to figure out things early. So that's what sort of, floats my boat when it comes to equity research. And then my interest, like in the consumer sector, was really just opportunity based. I was a research associate at my first firm, and the food and beverage analyst left, and they said, "Hey, you want to try?" I said, "Sure." So I've been doing that ever since, and love it. It's a fun industry. It's fun to go and go to the factories and eat the food right off the line, or you meet a lot of interesting people. So it's been a fun 35 years, and hopefully there's more left. So that's where I've been.
Great. So the consumer sector covers a broad swath of companies. Can you let us know what sectors within consumer you cover and are focused on right now?
Yeah, so the consumer sector, we've talked about it before, but it is quite wide ranging, so if you consider that Apple and Amazon and Netflix are all consumer facing consumer companies, Tesla's a consumer company, and so you get a wide range. I'm not tied to any one subsector in my coverage, but I do tend to cover what my closest to my longest experience, which is in the food and beverage and other consumer products. So anything sold at retail is really where I've had my focus. I also tend to cover the smaller names, the up and coming. There's where there's growth. I've always been sort of a growthier bias to my coverage. And that's what I sort of cover now. That's where my coverage is heading: smaller, micro cap, growth stories. I do monitor about 60 companies, including the large caps, because they're the leaders in the space. But I do cover, but my focus remains on the lesser known names.
How is the consumer doing, in your opinion? I mean, they seem to be somewhat resilient. Is that correct?
Well, they've been showing that, and data came out today, or we expect the data to come out with showing GDP growth of 2% and personal consumption in that same range. But the consumer is still adjusting to these massive price increases. I mean, we've seen 25 to 30% price increases over the last several years. And while wages are a nice offset to that and ease the pain, there's still sticker shock, and we're seeing the consumer a little bit of weakness, a little chink in the armor in the form of traffic increases are more in the value channels like mass and club, increases in private label, where consumers are searching for some value. And also we've begun to see some promotional activity pick up. So we're getting a sense that that the retailers and even the manufacturers are seeing some volume pressure. And then, in the fourth quarter here, consumer spending is going to be up, as I said, maybe 2%, but credit card spending's higher, delinquencies are increasing, credit balances are lengthening. So, we're a little cautious on the consumer here. It's not going to be easy.
What is your outlook for the broader consumer sector in terms of stock performance this year, and how would interest rate increases or decreases affect your view?
Yeah, I mean, we think we think the outlook for the consumer staples will be mostly a year of underperformance, sort of back to back. I mean, it's helpful to look back at last year. Last year in 2023, it was one of the worst years for the staple sector that we've ever seen, about a relative decline of about 30% compared to the S&P 500. So as interest rates rose last year, your larger cap dividend players really got hit because the 3% yield that these larger guys were paying, had tough competition with the 5% money market funds. So I think some money came out of the large cap into the money market fund, and then on the smaller names, they fared even worse, in fact. And a lot of it's company specific, but in the smaller cap food and beverage names and other consumer product, the higher the interest rates, the higher the cost of capital. Many of these companies are barely self-funding, so they're longer dated assets. And as interest rates rose, their values, fell like on a discounted cash flow kind of value. So it really had a tough time. But this year, if we see interest rates fall, I don't know where we are on that, but we would think that the dividend payers will be supported as investors look for yield, and we think it'll help the smaller cap names just with falling costs of capital and easier maybe access to capital. So it'll be, I think, interest rate dependent performance outlook for that group.
So taking a little bit of a longer term approach, what sectors or types of companies should investors focus in on over the next several years, in your opinion?
Yeah, so we think we look for volume growth. We think if you don't have volume growth, you can't really overcome your inflation. So you need companies that have real volume growth and maybe with a backdrop of a strong category. So we like, I mean, it's I don't say it's cliche to say health and wellness sector is a place to look, but it certainly is. It's where the growth is. It's because the consumers are looking for health and wellness alternatives and new products. And it's where like the innovation has really been. So, and maybe the other sector which has been good and continues to look good is the pet food and pet health and wellness sectors. They're very strong. But in health and wellness, it's a wide-ranging category. It's you can almost include gyms and things like that into health and wellness. But as budget gets tight, health and wellness spending is generally not pinched in household budgets. It's the one keeper, and that's why we kind of like the volume outlook for these companies. But broadly, we like nutritional foods. We like nutritional supplements. But we want to focus on companies with the above average growth. And the other thing is, they have to be self-funding. Because without the self-funding, the fear of equity dilution is always there. And then I guess the other thing I'd like to say is in the smaller cap names, we tend to focus, our efforts there because these larger companies are growth starved. And there's just been a steady cadence over the years of M&A. And these growth starved companies acquire the stronger, smaller companies to give them their growth. So that's our focus.
Great. Mitch, anything else you want to add before we conclude this discussion?
Yeah, I mean, well, we get, a lot of talk, a lot of questions about our view on the weight loss drugs, the GLP-1s that are coming out. It's one of the more interesting topics. And, these drugs clearly curb appetites. And the one issue, the one struggle that food, beverage, and even consumer product companies have is volume growth. And even if you only have 10% of the population on the diet drugs, it'd be enough to trim a 0.5% off of volume, and that's all the volume growth they have. So it would basically take your consumer staple stocks from a volume growth of under 1% to maybe closer to 0, and that's hard. That's hard on margins, and it's hard for the sector. And I think that's one of the reasons that some investors are a little more cautious on especially the bigger names. But it's an area you got to keep your eye out on, and it's not going to go away. So it's something you got to monitor. And we're not worried in the short term, but we are taking a look at how it does affect consumers' consumption in the longer term.
Great. Thank you, Mitch, very much for your time today. We greatly appreciate it. We hope everyone enjoys the rest of the conference. Thank you.
Thanks, Adam.